So an MRPA stands for Master Risk Participation Agreement. It's an agreement between a bank and CDC that says CDC will share or participate in the risk of trade transactions which meet a certain profile. You can think of it as similar to a guarantee, where a bank doesn't have the appetite or the ability to lend the full amount required. CDC will come in alongside the bank to participate in the transaction.
So as an example, let's say if a business in, let's say, Sierra Leone wants to import $100,000 worth of rice and applies for trade finance with its local bank. The confirming bank can contact CDC and say, I would like to finance this trade, but I'm currently constrained by my internal risk limits. CDC, can you provide higher risk cover on this trade? And in this case, the trade can go ahead, whereas otherwise, maybe it wouldn't be able to.
As part of the trade team, we were seeing delays in trade as lockdowns were being imposed all over the world. Ships could not port, goods could not clear customs, everywhere there was a delay. So it was a risky time. And the importance of the MRPA was to be able to provide risk appetite in these markets at this critical time.
So in the COVID context, the focus shifted to quickly getting liquidity into the markets at scale and helping to minimize the disruption of the value chains, especially there where the disruption is highest and where the consequences of disruption will be most severe to people. So working with our existing partner banks meant we were able to move quickly and deploy capital at scale through increasing the existing facilities that were already in place. So from an impact perspective, besides broader liquidity support during the COVID period, the objective was to ensure that capital is channeled towards impact priority countries and also sectors. There where we are most confident that our capital is reaching the more vulnerable economies and also the more vulnerable segments of the population. So first, we offer higher risk participation for impact priority trades. And secondly, we offer a longer tenor. As at the onset of the crisis, we observed that some trades took longer to settle. For instance, if it took longer for trading businesses to access foreign currency in country, and hence we allowed for a longer tenor than usual during the crisis period.
We had to give a lot of consideration to the level of the risk, given the level of market uncertainty that we were seeing, that was unprecedented. First, we wanted to work with known existing partners. We have a good relationship with our existing trade finance partners, and we have successful programs for which we had conducted extensive due diligence already on those partners. Second, we know trade finance has a low level of default and is typically uncorrelated to ordinary markets. Our financing was targeted to support essential imports, foods, medicines, infrastructure equipment. These types of goods are essential to our economies and the markets that we operated in and are always needed.